This is Taking Stock on Bloomberg. I'm Pim Fox. Now, it has been a difficult week for steel stocks. Take a look, and just to let you know that what's happening for steel companies in the S&P 500, Allegheny Technologies, well, we know, down 6%. Nucor down 8%. AK Steel down 13%. And U.S. Steel down 11.5%. But steel prices also continuing to fall, but that doesn't deter my next guest, even though they've dropped more than 3% since June. My next guest, he's got a buy rating on many of the biggest names in steel. Our expert, Marc Parr from Keybanc, he tells us what's going on in the steel business. Marc Parr, last time we spoke, you came out, you were bullish on the shares of
That's right.
U.S. Steel. Tell me, what's going on with pricing in the steel business right now?
Well, I say, Pim, since we've seen some of the dumping of steel by large OEMs back off in late May and early June, we've seen the U.S. market get much closer to global pricing. And we've seen actual spot pricing for carbon flat-rolled steel move from $360 a ton to $460 in the last 3 weeks. Steel prices in the U.S. remain well below the world levels. There's plenty more room for prices to move upward without any recovery in end demand.
What about the destocking issue? Is this really all that's going on? People replacing inventories? I mean, is there really any economic growth to justify increased steel prices?
I mean, really, we're seeing, the U.S. market well below the world levels. So that's one reason that prices can go up. I mean, we definitely have seen destocking begin to slow. We are seeing automotive supply chain re-engaged, but we're seeing more weakening in the non-residential and industrial construction markets. So overall demand is looking fairly leveled out. It's not declining anymore. That's very encouraging. But the fact that the destocking is easing is what's driving mill orders higher right now.
Now let's talk about one of the stocks I know you follow. This is U.S. Steel. We're looking at like 6 consecutive trading sessions of selling in U.S. Steel. The stock at one point in June, 11th, mid-June, we're talking about $40 a share. We're now down to about 31. You still like U.S. Steel?
Well, I mean, we've definitely seen some profit taking in the group. There's been some increased concern about the global economic condition. But the bottoms that the stocks look to be making in here looks to be a bit higher than the previous bottom. We think this pullback is a great opportunity for people to be looking at the names again.
Now, what gives you that confidence, though? Is it just the steel pricing is going to firm in the United States vis-a-vis the rest of the world? Is that where you make the call?
Well, I really think what investors are going to be looking for, Pim, as we move into the second quarter earnings season, is have we reached a bottom for the group? And all the evidence that we see continues to suggest that third quarter and fourth quarter are going to see upside from the first half. Part of that is going to be higher pricing. Part of it is going to be better matching of raw material costs. Part of it is just the actual fixed cost reduction programs the companies have been doing through the first half. But as long as these stocks and these companies can show the investors that the second half is going to be stronger, I think we've got a base here that we're making for more upside in the group. This is clearly an early cycle group. I mean, if you're going to be in equities and you believe the economy has got some room to get better next year, this is definitely an area where you want to be involved.
Marc Parr, there's certainly a lot of room for the economy to get better. You talk to people in the steel business, and you've noted in the past that you don't just start up a blast furnace without some real conviction. Are you hearing anything in the industry that would lead you to believe that they're making plans to restart a lot of idle capacity in the second half of this year?
Yeah, I don't think that I would use the word a lot. But I do definitely see evidence that we will see some additional integrated steelmaking capacity come back on. Just, Pim, remember how difficult it was for these companies to shut those furnaces down almost preemptively. And steel production has been well below underlying demand levels over the last 9 months. I don't think they're going to jump the gun, so to speak. They'll make sure they have the orders in hand before the new capacity comes back on. And I don't see this thing as falling apart, at least over the near term.
All right, we're going to continue the conversation more with Marc Parr from Keybanc. We're going to talk about Steel Dynamics, flat rolled pricing. He's got a $20 target on the stock. He thinks you ought to buy it. We'll find out why. We're also going to focus on some other steel makers whose products go into cars, appliances, and other big ticket items that could benefit if the economy starts to improve. This is Taking Stock on Bloomberg, a programming note. Taking Stock begins each weekday at 3 p.m. Eastern on Bloomberg, 1130 a.m., XM Channel 129, Sirius Channel 130, and on Bloomberg.com. This is Taking Stock on Bloomberg. My guest is Marc Parr. He's an expert in the world of steel. He analyzes steel stocks for Keybanc Capital Markets. Let me turn your attention, Marc, to Steel Dynamics right now. Okay. Tell me what's going on in the order book, because you say they're not going to return to 100% capacity until, go ahead, fill in the blank for us.
Well, I mean, a lot of it will depend on how quickly they can re-engage the scrap market. But I would say right now that Steel Dynamics' flat-rolled order book is running well ahead of the rest of the industry. And they've got a potential to be at 80% utilization by the end of the third quarter. Now,
that's for the flat-rolled. How about for the hot-rolled market?
Well, the flat-rolled and the hot-rolled are pretty much the same thing. I mean, flat-rolled would encompass hot-rolled, cold-rolled, and coated materials. The side of Steel Dynamics business that remains very weak is the non-residential construction side of the business. You know, their structural products area, which was one of the most profitable, easily the most profitable piece of their business 2 years ago, is now barely breaking even, operating at about 30% utilization rates.
Now, what about improved cost controls at Steel Dynamics? I mean, how much cost can they actually pull out of the business?
Well, you've seen, along with the reduction in demand and just the weakness in the economy, you've definitely seen reductions in pretty much all of the input costs associated with making steel. In addition, the company's taken mark-to-market charges on inventory that was acquired last year. So their overall cost position is in excellent shape as we look into the second half. We're definitely looking for sequential earnings improvement out of this company in the third quarter and fourth quarter. And because of this company's low-cost operating position and their product area exposure in flat-rolled, this is an ideal candidate for portfolios at the present time.
Now, you've got a $20 price target on the stock of Steel Dynamics. How do we get there? What kind of multiple are we talking about? 7.5 times embedded value to earnings before interest, taxes, and depreciation, all that good stuff?
Yeah, I mean, if you look in the last downturn, you know, as the earnings for this company were beginning to improve, market valuation on an enterprise value to EBITDA basis was in a 7 to 10 range. Our $20 target would represent about 7.5 times on our 2010 estimate. That 2010 estimate is still well below normalized, but it's definitely taking a step off the trough levels that we're seeing this year.
What about the credit markets and how that's affecting the balance sheet at Steel Dynamics? Any worries?
Well, Steel Dynamics has just gone through a whole capital structure redo, so to speak. They've raised some equity. They've renegotiated their credit agreements. There's no real risk here of defaults or any sort of issues with the banks. They are a leveraged company, and that reflects the fact that these guys have been aggressively growing the business over the last 10 years. And they've done that in a very appropriate way in our view. But at least from a financial risk perspective, over the next 12 months, you know, they've eliminated all the major risk factors here, and so really it just gets down to operations.
All right, we've got a risk factor. It's called time. I want to thank you very much, Marc Parr, coming to us from Keybanc Capital Markets.